If you are a dividend investor, I'm sure you know about DRIP, the Dividend Reinvestment Plan. But do you know which DRIP to use if you have a smaller account or if you're just a beginner? Watch this video till the end and I will show you how you can get started with a very small amount. Hello, welcome back. My name is David Das. I hope you're all doing well. Thank you for joining. In this channel, I talk about building wealth and income from the stock market. In this video, I'm going to talk about 5 things. Number 1, what is a DRIP? Number 2, the importance of DRIP. Number 3, different types of DRIPs and the pros and cons. Number 4, which DRIP is more suitable for a smaller account or for a beginner. And number 5, how to set up your own DRIP. So let's get started and let me share my computer screen. What is a DRIP? The DRIP is a program that allows investors to automatically reinvest the cash dividends or distributions on their stocks or ETFs into additional shares or units with zero commission. The most important thing is automatic reinvestment and zero commission. I will use a very simple hypothetical example to explain this. Let's say the investor has $2,000 trading account and he or she buys 100 shares of ABC at $20 a share. So at the beginning, the investor has $2,000 trading account and he or she purchased 100 shares at $20 per share. And so the remaining cash in that account is zero. And at the time, dividend per share was offered by the company as 50 cents per share. At the end of quarter 1, the dividend remains the same, 50 cents a share. And because the investor had 100 shares, so 100 times 0.5 is $50 as the cash dividend. The price of the share has increased from 20 to 25. So with $50 as cash dividend, the investor will get 2 shares. So at the end of quarter 1, the investor will have 102 shares, which is 100 plus 2 is 102. And the end of quarter 1, the value of the portfolio will be 102 times 25 is $2,550. Moving on, at the end of quarter 2, the company is still offering 50 cents per share. And because now the investor had 102 shares in the quarter 1, so 102 times 0.5, so the total cash dividend will be $51. The share price have reduced to $17. So with $51, the investor will get 3 additional shares. So at the end of quarter 2, the investor will have 105 shares, which is 102 plus 3. And the value of the portfolio will be 105 times 17, which is $1,785. Now moving on to quarter 3, the company has increased the dividend to 54 cents a share. So with 105 shares at the end of quarter 2, 105 times 0.54, the amount of cash dividend will be $56.70. And the price of the share has increased to $28.35. So the investor will get 2 additional shares. So at the end of quarter 3, the investor will have a total of 107 shares, which is 105 plus 2. And the value of the portfolio will be 107 times 28.35, which is $3,033.45. So you can see the number of shares are rising, and that's the power of DRIP. And this is all happening with an initial investment of only $2,000. So think about it, that if you want to invest regularly, what would have happened with the compounding growth? We will talk about that in a bit. Continue watching this video as life gets more interesting with some real life examples. Now let's talk about the importance of dividend reinvestment. As we have just seen, there are so many advantages of DRIP. So let's talk about the pros and cons. For the pros, we have dollar cost averaging. The investor buys shares whether the share price is high or low. Autopilot investing. Once the DRIP is set up, everything is automatic. Cost savings. There is zero commission, so the investor saves money in the long run. The power of compounding. The DRIP can help to supercharge your long-term returns. The long-term view, we do not have to worry about the short-term fluctuation of the stock market or the particular sector. Actually, the investor gets more shares when the prices are down. Open to all, as long as the security is DRIP eligible, anybody can participate in this plan. Now, what are the disadvantages of DRIP? Number one is the diversification or the lack of diversification. Risk exposure and balancing portfolio. There is a higher risk exposure to one security or the sector. Balancing your portfolio may be needed depending on your desired threshold. Taxes. If this account is set up in a non-registered account, you have to pay taxes on the dividends. No cash flows. As dividends are invested automatically, there's no income or cash flow as such. You're buying shares at both high and low prices. Cost basis calculation for taxable accounts, determining your average cost can be a bit tough. However, the reporting process is getting simpler every day. Dividend risk. The company may choose to cut or eliminate dividends in the future. The eligibility. Not all securities are eligible for DRIP. Now we are talking about item number 3, which is the different types of DRIPs and their pros and cons. Generally, there are 2 types of DRIPs. Number 1 is the synthetic DRIP or the brokerage managed DRIP. This is the easiest option. You just have to call your broker and they will set up your account for the DRIP. These are offered by most of the brokers that will allow you to reinvest your dividends without commission. So this is a fully automated process. Now, the pros and cons of the synthetic DRIP. There's only one advantage, in my opinion, for the synthetic DRIP, that it is easier to set up, and you just have to call your broker and they will set up your account for the DRIP. On the disadvantage side, it will need larger capital because you have to have enough dividends to buy at least 1 share. No fractional shares are allowed in this DRIP. The broker will only allow you to buy full shares. Any remaining dividend balance will be deposited as cash. For example, if you get $25 dividend and the share price is $20 at the time, you will be able to buy 1 share and the broker will deposit $5 into your account. So the money that is sitting as cash, it is not fully reinvested. You will be called a non-registered shareholder or a beneficial shareholder. And there is a possibility that the DRIP will be set up for the whole account. So if you have 5 stocks in that account and you call the broker to set up your DRIP, either you do all the DRIPs or no DRIP. So you cannot have only 1 stock on the DRIP side and 4 stocks on non-DRIP. You cannot do that for that particular account. And these pros and cons are in addition to the ones I already mentioned. We will use the hypothetical example we talked about before and see how it works for synthetic DRIP. The investor has a $2,000 account, so he or she buys 100 shares of ABC at $20 a share. So the portfolio value at the moment is $2,000 and there is no cash. At the end of Q1, the company has declared a dividend of 50 cents per share. Because the investor has 100 shares, the dividend will be $50. The price of the share has increased to $25.05, and that can only allow you to buy 1 share out of this $50 dividend. So that's 1 share, and the remaining $24.95 is deposited as cash. So at the end of Q1, the investor will have 101 shares, and the value of the portfolio will be 101 times 25.05 plus your $24.95 cash. That comes to $2,555 at the end of Q1. Moving on to Q2, the company again announced a dividend of 50 cents a share. So now the investor has 101 shares. So that will come to $50.50 as the dividend. The price of the share is now $16.95. So that will allow the investor to buy only 2 full shares and the remaining $16.60 will be deposited as cash. So the end of quarter two, the investor will have 103 shares, which is 101 plus 2, that's 103. And the value of the portfolio will be 103 times 1695 plus your cash of 2495 and 1660. That will be total of $1,787.40. That will be the portfolio value at the end of quarter two. Now, moving on to quarter three, the company has announced a dividend of 54 cents a share because the investor had 103 shares. That translates to $55.62 as dividend. The price of the share has increased to $28.35. So you can only buy one share, and the remaining $27.27 deposited as cash. So the total portfolio value at the end of quarter three will be $3,017.22. At the end of quarter three, for synthetic drip, the value will be $3,017.22. That will include the cash amount of $68.82, but the number of shares will be 104. Now let's talk about the next type of drip, which is the full drip with the share purchase plan. This is also called as the traditional drip or the treasury drip. These drips are actually managed directly by the company or by a third party, such as a transfer agent. Popular transfer agents in Canada are the Computershare and the TSX Trust Company, and I will talk about these transfer agents in a minute. Now let's talk about the advantages and disadvantages of full drip. So for the pros, we can get started with this very small capital. Sometimes you can actually get started with $500. The fractional shares will be allowed, so all your money is reinvested. You can sometimes get shares on discount if the companies are offering these shares from the treasuries. There is also an option for share purchase plan in the future. If you want to invest, say, $250 every month or every quarter, you will have that option with this drip. And you are a registered shareholder with this type of drip. On the con side, it can be very complex, it can be a bit time consuming, and it can cost you some money. Not all companies offer this drip. Sometimes the company can terminate the program. And also there are some rules for minimum investments and how much you can invest in what time frame. These pros and cons are again in addition to the ones that I already mentioned in the drip. Now let me give an example. So we will use the same hypothetical example. The investor has $2,000 and buys 100 shares of ABC at $20 a share, and at the time there will be no cash left. So moving on to end of quarter one, the company declares a dividend of 50 cents a share, and because of 100 shares, the amount of dividend will be $50. The price of the share has increased to $25.05. So with that $50, now the investor will get 1.996 shares. And you can see there is no cash. So all the cash is reinvested. So the end of quarter one, the number of shares will be 100 shares from the before and 1.996, which is 101.996. So the value of the portfolio will be this times 25.05 will be $2,555. Moving on to quarter number two, the company has declared a dividend of 50 cents. Now with 101.996 shares, the amount of dividend will be $51. The price of the share has decreased to $16.95. So with $51, the client will receive 3.009 shares. So the total amount of shares at the end of quarter two will be 105.005. Now moving to quarter number three, the company has declared a dividend of 54 cents a share. So for 105.005 shares, the amount of dividend will be $56.70. And the price of the share is 28.35. So the investor will get 2 shares, and that dictates to total portfolio of 107.005 shares. The value of the portfolio will be this times 28.35 comes to $3,033.59. The amount of shares will be 107.005, and the cash will be 0 because all the cash is reinvested into the shares. So if you want to compare this with the synthetic drip will have the portfolio value of $3,017.22, whereas with the full drip, the value is $3,033.59. Number of shares with the full drip is 107.005, and with the synthetic drip, it's only 104 shares. So you can see that with the full drip methodology, the investor will have more shares and higher portfolio value. And you can imagine if you continue to do that over a period of time, like say 5 years, 10 years, 20 years, 30 years, there's a huge difference. And for the long-term growth, it's phenomenal. I have done it myself, and you can see the phenomenal growth of your capital if you go with the full drip on a long-term basis. So number 4, which drip is more suitable for a smaller account and for beginners? We have just seen that for synthetic drip, we need to have relatively large capital, and it's easy to set up. Just call your broker and the account is set up. With the full drip, with the optional share purchase plan, they usually require less capital, and the investor has an option to contribute regular payments in the future. The process is generally the same with all the companies. The specific rules are different for each of the companies. Most companies that offer drip provide details on their website. Account setup is a bit cumbersome, but from my experience, I can tell you that this eventually will pay off in the long term. Now we are going to talk about how to get started and set up your drip account. I will provide some examples later. Let me highlight some of the main points. For the synthetic drip, you have to find companies which offer drip. You can use the company's investors relations website to find more details. If you do not have one, open a brokerage account, deposit some cash, then buy your favorite dividend stock. When the dividends are paid, they will be automatically be reinvested. Keep in mind that you will only get full shares, and any balance remaining will be deposited as cash. Now we are going to talk about how you can set up your full drip with optional share purchase plan account. Number 1, you have to choose companies which offer drip. You can use the transfer agent's websites, which I will explain later, or you can use the company's investors relation website to find more details. In Canada, you have to own 1 shared certificate in your name to get started. This can be done in few ways. Number 1 is a brokerage account. You buy shares like you normally do, and you call your broker to send 1 shared certificate in your name. This is how I started 20 years ago. The second option is a private buy. Find someone who is willing to transfer 1 share from their name to your name. The seller will charge the share price. They will charge the courier fee or the postage and some additional fees. The seller has to follow certain rules for transferring the share certificate in your name. The third option is a drip club. There are some clubs whose members will be able to transfer 1 share to you, just like I described. After that, you fill up your drip enrollment forms available from the transfer agent's website and submit them with the shared certificate in your name and the money to the transfer agent. These rules are constantly changing, so always visit the company's investor relation website or the transfer agents to get the latest. Now I'm going to show you a few examples. I will pick 2 Canadian stocks and 2 US stocks. These are not stock recommendations by any means. Please do your own research and then you decide accordingly. So let's say I'm looking at the Royal Bank of Canada. So I am going to their investor relations website. All the links will be provided in the description below. So this is the link. If I go to the Dividend Reinvestment Plan, it has all the information what you need to know. And you can see here additional shares from treasuries are provided at the 2% discount from the average market price. This is exactly what I was talking about before, about there is an opportunity to buy these shares at a discounted price. But again, it varies from company to company. Then they have a link about the transfer agent, and their transfer agent is Computershare. The next stock on my list is BCE Inc., which is Bell Canada. And if you click the link, it will take you to this page where it has all the information that you need in terms of the dividend reinvestment plan. It also has the transfer agent information, which is the TSX Trust Company. So you download, you read, and you fill up the forms as they have indicated. The next stock is a US stock, which is the Coca-Cola. So I go to their website. So this is the information from their Coca-Cola website. It says what to do in order to buy more shares. And they have referred us to the Computershare website, which is, this is the information about the Coca-Cola company at the Computershare website. It has the brochure, it has the enrollment form, it has different options, the fees, the plan features. So you can download and print all the forms that you need. The last stock on my list is Home Depot, and I'm going to their investors relation website. Again, it has all the information. The minimum initial investment is $500. It has information about different fees and also their transfer agent, which is the Computershare. So all these links will be provided in the description box below. Now let's talk about the transfer agents. As I mentioned before, there are two important ones, which is one is the Computershare and the other one is the TSX Trust Company. These websites are so powerful that definitely you should use them for your research. So let's go to the Computershare website. This is the Computershare website for the US. You can see a list of all the stocks that's available for DRIP. You have to do your own research and decide which company you want to invest in. You can change this to Canada. Once you change it to Canada, you go to investment plans. It will give a list of all the Canadian companies that offer DRIP. Again, pick your company, do your research, and decide where you want to do the investment. Now let's talk about TSX Trust Company. So this is their website. The best way to get started is that you have to search for a company. So I will probably recommend, say, if you start with A, just type in A, it has a list of all the companies starting with A, which offer DRIP. And you can do for B and whichever company you want. So these are companies starting with B. If you have any particular company name in your mind, say, for example, Imperial Oil, you type it in, and it has the information about Imperial Oil. So I find these two websites are very powerful in order to get the information about the companies. If you are outside US and Canada, you can use the Computershare website to do further research for stocks of these countries. I hope you liked the video and thanks for joining. Thumbs up if you like it, and I will see you in the next one.